Good morning, traders. Chris Buss here with Traders Profit Compass with another edition of Before the Bell, your home for actionable pre-market content. It is Thursday, April 7th, 7:05 a.m. as I'm starting the video. And as always, please run your player at 1.5x. Quickly looking at futures, Bitcoin down 1%, oil up 1.5%. Equities in the green, up about between 0.3 and 0.5 this morning. Gold and silver mostly flat. Copper's down about 0.5%. This morning on the macro front, I'm sure there'll be commentary on yesterday's FOMC minutes. We've got Jim Bullard at 9 a.m. We've got Charlie Evans at 2 p.m. I think we've also got a speaker at 4 p.m., but that'll be after the close. And then, of course, we've got jobless claims being Thursday and nat gas inventories. I want to make a couple quick comments on the FOMC minutes yesterday. And I want to point out that on the blog this morning, in this morning's post, I'm going to provide a link to a 6-minute video former Fed Governor Bill Dudley on Bloomberg yesterday with a very nice, concise, clear statement of the conundrum the Fed is in and how they're going to tackle it. And I will give you the thumbnail version of it now. And while there may be nuances, it basically comes down to this. The Fed's task now is to knock down financial assets, namely the stock market and the housing market. And if they have to sacrifice some jobs along the way, that's what they're going to do. So getting back to what we were saying for the last couple of weeks, the Fed holds the high ground, and they are going to keep hiking until they get what they want, which is the stock market to go down and housing to go down. Why? Because they want to initiate the reverse wealth effect to knock down demand. Because the inflation is a dynamic between not enough supply, and we've all heard about the supply chains, and in excess of demand. So when you have more demand than you have supply, prices are going to go up till they find that equilibrium, and then it starts this flywheel, and you've of that upward spiral where the demand keeps going and the supply can never catch up. And that's where you've got that rising inflationary environment. So I want you to keep that in mind. Dudley could not have been more clear. Brainerd the other day said the same thing in a more convoluted way. The Fed minutes yesterday made it quite clear. You're going to get 50 bips in May, and you're going to start getting 95 billion of Fed balance sheet runoff. And it's never been done before. Literally never been done before, having that sizable of a balance sheet runoff in combination with an aggressive rate hiking cycle. So all these whatever rallies that come out, that happen in the marketplace, just remember that the Fed is there with a bazooka to knock it down. And that's the backdrop that I want you to keep in mind. I can almost assuredly say that I I doubt we're going to new highs in this environment, because what's going to happen is even if we put in a sustained rally, instead of, one or two rate hikes at 50 bips, they'll do 50 bips every single time, because they'll feel like they have license to do that. Why? Because financial assets have not gone down. And without those assets going down, there's no way inflation is going to go down. And then why? Because they can't print copper, they can't print oil, they can't print wheat and corn and aluminum and lead and every single thing that's going up. They don't control. The only thing that they control is liquidity in the form of interest rates and balance sheet runoff. And so that pool of liquidity now has the drain open. Now, for us, we got to trade day to day or week to week. So knowing that the Fed is there ready to throttle any big rallies is critically important, but we still got to have our levels in mind and tactically trade this environment. And one other thing before I get into the charts, on the blog site this morning, I'm going to leave the post up that I had yesterday, how to doomsday proof your portfolio. Go through that and get in your mind, if you want to be long assets, which are the ones you want to be long and which are the ones that you either want to avoid or short. So just one example of that is Walmart. That's a position we entered just a week ago. Non-stop, all day. From lower left to upper right, all day long. Buying, buying, buying. Defensive names. Look at defensive pharma. Merck, Pfizer, big name pharma, up. What else? Altria, Philip Morris, tobacco companies, all the staples were up, all the utilities were up, all defensive stuff. So keep that in mind as you're going forward. Okay, let's roll. NASDAQ McClellan oscillator. We were at the highs. We anticipated a move down. We got it right in the middle of the range. What I expect to have happen is that we end up down in this oversold area where we will look to either cover shorts or play for a bounce. New York oscillator, same thing. Not much to add there. If you look over at the NASDAQ high lows, you can see we were rejected at 0 the whole time since last November, not being able to have more highs than more lows. So now that bounce cycle has completed and it appears that we're rolling over. Can this reverse at any time? Sure, there can be a rally, but we've had some pretty vicious rallies since then, since the beginning of this whole thing, and they all die at the 0 line. So I think that's important. And you can find the exact same chart on the New York high-low, shows the same exact thing. VIX. Continue to look for trend intraday, but in general, notice some higher lows and higher highs. So, I mean, that's an uptrend, right? So, over the course of the last 6, 7, 8 months, the floor for the VIX has been rising, and it reaches a higher and higher level with each successive cycle. So I think a higher volatility regime is important, is an important part of the narrative going forward, and one that you should keep in mind. And one of the things that we would certainly take note of is if there's some kind of a rally that rolls the VIX over and we take out these prior lows, then something else is going on in the market, and you'd have to conclude that, you know, this trend will have been broken. Interesting chart here. I keep this is a ratio chart between high beta and low volatility. It's been in a trading range, and here were the violations in February and March, and now we've rolled back out of the box and heading down. And again, that's the outperformance of defensives versus high beta. Here's another way to look at it. We've been showing this over the last couple of weeks. Utilities, racing, healthcare, racing, staples, moving higher against consumer discretionary. You know, defensive versus offensive. Defensive is coming back. Staples versus SPY coming back. And SPY versus QQQ, not as dramatic as these examples, but certainly staying within the idea that the Qs are falling behind SPY, and that's never a good setup. SPY daily, I haven't put the gap in here, but I think your pivot point is 445, and I would certainly make note of where the 50 EMA, we came down for a tag of the 50 yesterday and it bounced, and then where the 200 is in relation to price. My expectation would be that if you lost the 50, I think sooner rather than later, price will come down to tag the 200. Here it is, blown up. I think, as I mentioned, this 445 is an important level. Notice the void in the charts below, that I think it would, you know, if we breach that 50, which is here in gold, that corresponds to the 50 on the daily chart, that you would quickly come down to 440, where you've got another larger zone of support that extends down towards 434-ish. So keep those levels in mind. Here's where I have the gap marked. Now we're up a little bit this morning. If there is some kind of rally where we get above 449, I mean, you can get long. I mean, we're all about tactical trading. So, I mean, you can get long. Or if, since we're up, there's going to be a gap below price on the open, right? So if price makes a flash move to fill the lower gap and holds at 445, you can be long there with a stop just below and look for a move back up towards 453, where you've got the downtrend line and lateral resistance. But then on that rally, I would be looking to fade that. So I think those are the key thoughts for this morning. And if for some reason we were to lose 445, then I think you can be short there and looking for lower levels as shown below. Moving on to the Qs, a little different setup here from the standpoint that price is now below all the moving averages. Notice here's the the 8-day was way up here. Then we got the 200, we got the 20 and the 50. I think what is it? 353.50 right in there. 350, or excuse me, 353, 353.50. You can fine tune that. As long as that holds, I think you can be long and see if we don't get this gap fill. But if it breaks out of here, breaks above the gap, and makes a run back up to these highs, that's going to be another, in my opinion, golden shorting opportunity. And if we were to break below yesterday's close, your first target will be the low of yesterday. And you can see it a little more clearly here on the 2-hour chart, where we had some looks below, but there were responsive buyers there that basically kept price above 352.50. So I think that's going to be an important level. And here you've got the range of the gaps, and the bottom of the gap. That's a pretty good sized gap. That's what is that? $4. So I mean, that would be a good one to participate in if they're going to run up and fill this gap. And at the top, if you catch that move, then you've got to keep your antenna up for a potential rejection or a potential breakout that would go up to this 365 level. Here it is on the 30-minute chart, just giving you some more detail. And while I got it here, take note of the prior trading range. Why? Because if we fall back below 347.50, we'll be back in this trading range. And like we always say, once you break out of a trading range, you don't want to re-enter it from above. So you can think of this as a breakout, comes back for a back test. That's fine as long as it holds. But if it doesn't hold, then your target is back at the lows. That won't happen in a straight line probably, but that will be your technical target. IWM, price below all the moving averages so that full bear stack remains in place. I think you can be short below 200, and if you get any kind of rally back up to 206, that's going to be another very objective shorting level. You can see all the line of rejections right there across 206. Here I've got the gap penciled in, and you see where price was able to hold the line. Also notice that you've got the two biggest volume over price bars on the chart from 200 to 198. So you can think of this as a support zone, but if price were to drop below 198, you can see that support falls away once you drop below 198. So keep that in mind, and I would certainly like to see you be short IWM below 198. And if you get lucky and you get a gap fill and a breakthrough up to this downtrend line, all the better as a place to get short IWM. I think it's going lower. Here it is on the 30-minute chart. You can see that 200 right here was a really nice line. So if this morning, we make a little run up and then come back down, that would be a short entry as well. So you've got the trend line and the gap on the upside. Facebook, looks like I forgot to put in the gap. Sorry about that. I think your pivot here this morning is this 223. That is where we've got the prior low here, and you can see quite a number of hours that the candles reached down for 220. What is that? I'm trying to look at it here. I guess it's 222.50. So yeah, right in that area would be your next pivot. And if it were to break these lows and these lows here, then that opens the door for the next leg down. Apple, here's your overhead gap. Here's all these levels that have worked so well. Notice yesterday that after the gap down and we lost 172, it went right down for a touch of 170. And that's kind of what I bring to the table. That's why I'm here, presumably to help you with these levels. And so they've worked really, really well on Apple. So I think today the pivot is 172. You drop down below 172. I think you'll come back to 170 quickly. And then there's another level here at 168.50 would be the bottom of that support zone. So, and then you've got the gap above. So I think those remain the key levels for Apple. Tesla, now we've got a small gap above. Here are the levels, and price made a move into the gap, and then the lower gap, and then came up. So this gap is yet to fill. If you got to move back up to fill this gap that got to 1100, I think that's a very objective place to try a short, because then you could put your stop just above that. And, if you get stopped out, you get stopped out. That's trading. But I can tell you that 1100 is going to be a very objective level. And then on the downside, I think you've got to set an alarm. Even if you don't get don't get the gap fill, or somehow you were preoccupied with other names or whatever, why don't you go ahead and set an alarm at 1000? Because notice the big gap in the charts, the void. You don't really have a lot of support coming in until you get to 940, and then 910 right here. So if price breaks down from this big trading range between 1,000 and 1,100, and you break 1,000, your measured move will then be 900, and that lines up really well with the volume over price bars and the lateral support zones from the chart. So I would be looking for a $100 move on a break below 1,000. I think that's going to be certainly an objective trade, but also one with a good risk reward. Microsoft, you've got the gap up here from the breakdown, and remember, sandwiched in between where price closed and where the gap begins is that critical 305 level. I thought it was really interesting that when it gapped down, it made this rally and then really could not close above that 305, and that, this prior low here, support here, and if you go back in the chart, 305 was the level that it broke out from immediately. So price does have muscle memory. It knows where it's been and where it hasn't been, and it knows people are up here that are trapped, that when price moves up, they want to sell into that. I mean, that's by definition overhead supply. But if you do get the breakout above 305, it's a beautiful level to shoot against. So here this morning, let's just talk this through. We know 301 is a fairly important level. Why? Because you've got a big volume over price bar there. So if we open below 301 and recapture 301 from below, that's where you take it long. Set yourself an alarm there, because you've got an open path up to 305. And if you were able to get in near 301 and then you get to 305, you can do one of two things. You can, well, actually three things. One, you can take it off with the $4 gain. You could roll up your strikes to, if you think it's going to break out, then you can buy a 305, something at or close to the money, and then hope for a breakout and a gap fill. And if that happens, you're going to be golden. And then the last thing would be close out your long and try a short against 305 with the idea that it might have trouble getting through there. So if you had notions of trading Microsoft today, your key levels are 301, 305, and 307 for the gap entry. Amazon, head and shoulders, broke the neckline yesterday, came down. I think your pivot today is 3,200. Here are the gap levels, and always keep in the forefront where the 200 EMA lies. I think if you break 3150, you're going to come down to 3085, something like that, and that will fulfill this measured move target right down here towards 3100. I think because of where the large volume over price bars are and this prior trading range, I think it would come down right here to 30 3080, something like that, 3085. So have those levels alarmed. If you want to go to the long side, I would have 3200 alarmed. If price makes a move from below and recaptures that, I think you can be long and then look for a gap fill up towards 3275 on Tesla. Here's Google. I think your pivot is right here at 2750. If you recaptured that this morning, I would want to be long. Pretty far distance up to the bottom of the gap, up here towards 2785. And then a gap fill all the way up towards 2810, it looks like. So on a breakdown below 2710, I would be looking down here towards 2680 and then 2660. Netflix. A lot of these charts look the same. That all the tech gap down. So you've got a gap down situation here as well, and above 375, I would want to be long to try and get that gap fill. But on the downside, I think this 363 at the prior low is going to be your pivot, and once you get that going, it'll start rolling downhill quickly. And as we discussed the other day, I think somehow this prior low is going to be retested again in the future. That's usually kind of how it works. Semiconductors remain under pressure. Yesterday we talked about this A, B, C move that projects down to this 248, 246 area. If you were to get a kickback rally to close this gap, I think you want to be short at that point. And notice where the large volume over price bar comes in. I wouldn't be surprised if there was a rally that got stopped right here before the gap fills at around 256.50, something like that. So I think semis are gonna remain under pressure. Housing remains under pressure. We're short that. At least some of us are looking for lower prices. There's going to be a decision point coming up around 55 where there's some good support, higher volume over price bar, and so I wouldn't be surprised if there was some kind of a bounce at or around 55. Give a little kickback. But remember, housing is one of the financial assets that the Fed is going after. So I think with the rising rate environment, no matter what anybody says, that the difference between 3% and 5% on a mortgage is really not that much. Maybe it isn't, but it's not better. And that's the point. So as mortgage rates rise, I think it's gonna knock demand down to a certain degree. Retail, it was down 165. I think you should have, if you're not already short from up here, I think you should have 72 alarmed on the low side. And if you wanted a second bite at the apple, say you missed this move, but you still want to be short retail, get a kickback rally to 76.50 at this large volume over price bar. I think I would be skeptical if retail could break out from, above 76, 50, 77 area. I think it would come up, get rejected, and then roll right back over. And we haven't talked about it much today, but I just want to remind you, this is classic bear market action on PPO. Why? PPO rises from below within the bearish regime, and then it puts in a bear cross right at the zero line at the top of the bearish regime, and then typically rolls back down. So that's your bear flag. That's your bear market rally back up to the zero line, but the bulls just don't have the power to, push it positive. Now, if this were to break above the zero line and start going up, you'll certainly see that in price. And then, that idea of wanting to be short retail will have failed. I mean, if price breaks out above 76.50 and then takes out the 50 from below, which was resistance over here, and starts rallying, then you gotta get out of your short position. If PPO breaks above, RSI breaks above 50, and price breaks above certainly the 50 EMA down here, you'd have to get out. Let's wrap it up there. If you're new to the channel, thank you so much for spending some time with me. You can tell from the analysis it's all technically driven with certain macro backdrops that I try to point out. That's really not my forte, however. It's all about the technicals. I try to give you objective levels to trade against. If that appeals to you, please hit the subscribe button, the like button, and the alarm bell so you'll know when I publish new content. And if you would like, jump over in the show notes. There's a link where you can register for all my content with your email address, and then morning, noon, or night, whenever I publish something, you get it right in your email box. So, quick recap. You got Bullard at 9 o'clock this morning, probably going to hammer home, rapid, accelerated rate increases along with aggressive balance sheet runoff. The Fed's at the top of the hill with all the governors having bazookas to knock inflation down. The way they're going to do that is knocking down financial assets. It's the only mechanism that they have. If you want to be long something, go on the blog site and look at these zones where I think will be more productive, namely defensive names, stuff like that. Stay away from the high beta stuff. If you go through and look at the ARC complex, that high beta, unprofitable tech outperformed to the downside. I mean, -4, -5, -6%, stuff like that. And if I think, if in fact the market does roll over in a bigger, more meaningful way, I think the ARC stocks will continue to outperform to the downside versus an Apple or some mega cap tech name that has real earnings and a good profit stream. So have a good day of trading. I hope you do well. And this has been Chris Buss with Traders Profit Compass. Talk to you next time.